Um, and, um, and also following today's presentation, we'll have some time for Q&A. We encourage attendees to submit those comments and questions through the Zoom Q&A function. And we'll also be sharing today's presentation following today's call. Elizabeth Coates is also here to provide a national policy update toward the end of our call, but again, we'll definitely have plenty of time for Q&A following our featured presentation. Speaking of which, we're so pleased to welcome back Michael Fratantoni, who joins us on behalf of the Mortgage Bankers Association, the MBA, joining us for today's Community Impact Briefing. Michael Fratantoni is MBA's Chief Economist and Senior Vice President of Research and Business Development. In this role, he's responsible for overseeing MBA's industry surveys and benchmarking studies, economic mortgage origination forecast, and policy development research for both single-family and commercial multifamily markets. And additionally, he's a member of the board of directors of Convergence Collaborative and Smith Enterprise Risk Consortium's Advisory Council. Finally, prior to joining MBA, Michael worked in risk management and senior economist roles at Washington Mutual and at Fannie Mae. Today's call, Michael joins us as he has for the past few years to provide the MBA 2025 economic forecast, which we've titled, "What Will the New Year and New Administration Mean for the Real Estate Industry? Stable or Slow Growth? Housing Rebound? Interest Rates?" Well, we're here to learn more about these economic insights for the new year. So with that, let me welcome Michael Fratantoni. Mike, I think you're ready to share your screen. I'll turn this over to you.
Chris, thank you. Appreciate it. And good to be with everyone. Thanks to you and Elizabeth and Raquel for having me here today. And again, appreciate the ability to kick off the year by talking to your group as well. So yeah, I'm going to cover the landscape today, really looking at some of the factors driving the macro environment, what's happening in the job market, talk about our expectations for interest rates, then really dive into some of the housing and mortgage market trends that we're tracking most closely. So obviously a lot of interest in what is really an increasingly uncertain world. So I always like to start by taking the big picture, what's going on around the globe. We are seeing weaker economies really outside of the US relative to what's happening domestically, particularly in Europe, but also in China and elsewhere. And with that, we're seeing central banks around the world cutting rates in response to try to help boost their economies. But we've got this curious instance where while short-term rates are coming down for the most part, longer-term rates are going up. And this is a reflection really of the much less favorable fiscal picture that many governments around the world are facing, again, including the US. And we've seen a recent tick up. And one way to summarize this is in the US, since September of last year, short-term rates have come down a percentage point. Longer-term rates have gone up more than a percentage point. That's not normally what we see in a Fed rate cutting cycle. So we can talk more about that as I go further along in the presentation. So zeroing in on the US now, here's what we're thinking with respect to expectations for economic growth for the next couple of years. So here I'm showing GDP growth going back to 2008. And really the surprise has been just how robust the recovery has been coming out of the pandemic. Now, in 21, that was just sort of a bounce back. That was expected. But the fact that we've still maintained economic growth above 2% for the last 3 years really has been a positive and very welcome surprise. You can see our expectation here. We think growth is likely to slow more in line with trend growth over what we think is going to be over the next decade, which is probably going to be less than 2%. So still positive, but somewhat slower growth than we've had the last couple of years. And a bit of a divergence between the manufacturing and services sector, where now for much of the last 2 years, we've actually seen the manufacturing sector shrinking. That's what being below 50 by this ISM measure means. While the services sector has been really the source of that broader economic growth that we've seen. So all that's a bit abstract. I always find it's helpful to really dive into the job market data because that's a lot more tangible for people. And so here I got two pictures for you. One comparing growth in the household and establishment surveys. The household survey tends to always be more volatile. Those are the gray bars on the line here. The orange, the payroll tends to be a bit more consistent with steadier trends in the job market. But honestly, both have been showing a lot of noise lately. And here we show that, with the household survey actually showed employment declines in October and November, then this very strong rebound in December. So let's zero in just on the payroll data for a minute. So what I'm showing on this chart is in dark blue, average monthly payroll growth going back the last 15 years or so. And again, like with the growth chart, you show that steep decline in employment in 2020 when the pandemic hit the economy, and then the very, very rapid rebound in 21. And then again, that surprising job growth that we saw in 22 and 23. The light blue bars are showing job growth in 24. And here you start to see a bit more volatility. Some weaker months, particularly October, reflecting those the hurricanes that hit North Carolina in particular, but Florida as well. And then you see some stronger months, with December being the most notable one. That 256,000 gain in December, much stronger than markets have been anticipating. Now, from a household perspective, the unemployment rate may be the most important thing to watch, and that's the orange line here. Again, we got a spike in unemployment during the pandemic, but by the time we got to the spring of 2023, the unemployment rate got as low as 3.4%, and that was the lowest we had seen since the late 1960s. Since then, it's drifted up. We were 4.2% in November, dropped back down to 4.1 in December. Again, a positive surprise for the market. Our expectation is that with a slowing economy, that unemployment rate's likely to increase from here, probably to something like 4.5% by the end of this year or early next year. And we are seeing some signs of this softening. We're seeing the rate at which employers are hiring. It's about as slow as it's been in the last 15 years. We're not seeing a lot of layoffs, but what this chart is showing is that for those folks that do lose a job, their unemployment spells are tending to be longer. So again, with businesses being more cautious about hiring, for folks that do lose a job, it's just that much tougher to get back into the labor force. And for new entrants, for new graduates, many are reporting it's really a tough time. And again, it lines up with this picture of it's not that the job market is weak at this point, but it's cooling a bit. And again, employers being a little more cautious. So when we talk about the job market, sort of really brings to the fore one of the two topics that has been such a focus of conversation about this presidential transition, which is an expectation of moving to a much tighter immigration policy and thinking about what that could mean for housing markets. And first, as I'm showing here on the supply side, is just the recognition that the construction sector typically has been very heavily reliant upon workers who were not born in the US. And different estimates about what proportion of those construction workers are authorized to work here or not. Regardless, it's a sector that's very much reliant upon immigrants to staff those positions. And absent that workforce or a portion of that workforce, you're likely to see faster growth in construction wages, and with that being transmitted to higher costs. A second topic of conversation is certainly around the fiscal picture, and I talked about that jump that we're seeing really around the world with respect to longer-term rates reflecting concerns about large and growing debt and deficits. And here on the left, showing data from the Congressional Budget Office, their projections of the federal debt relative to GDP. We're at about 100% right now, sort of where we were at the peak in World War II. And that's projected to grow rapidly from here, largely due to the aging of the population, growing spending on Social Security, Medicare, and Medicaid. Just to put that in context, on the right, a neat chart that Deutsche Bank put together looking by presidential administration at the average deficit to GDP for all of these presidents going back to George Washington. And you see that Biden administration at more than 7%. You have to look at the Roosevelt administration during World War II or the Lincoln administration during the Civil War to see a deficit so large. So really, really significant pressures on the budget side and constraints. And I think for folks in our industry, sort of recognizing that we are likely, sort of regardless of the political situation over the next couple of decades, it's just going to be a much, much tighter budget environment. Now, lots of conversations around the Department of Government Efficiency and potential cuts they might be looking to make. Lots of sort of initial interest in, well, could that impact the federal workforce? So just showing total federal government employees here. And then a map on the left from the CRS looking at where those employees work. So some conversations, there was a report just this morning about potentially NASA moving from their Southwest DC location to Cape Canaveral. But you can see due to, and this chart on the right tells it well, the fact that most of these federal government employees work in either the defense sector or Homeland Security. That's where most of the employees are already fairly well spread out across the country. Don't expect that concentration of the federal workforce is likely to change too much. And again, also don't expect significant reductions in that employment. Next macro factor after the job market is what's going on with inflation. And big news the last couple of days where both the producer price index and the consumer price index came in a little bit better than market forecasts had indicated. So that's really the first good news we've had in inflation in some time. So what I'm showing here is just the history going back to 2018. Before the pandemic, most of the concern was that inflation was too low. It was below this gray dashed line, which is the Fed's inflation target. That changed rapidly in 2022. We got to inflation levels we hadn't seen in 40 years. The Fed rapidly raised rates in response. Inflation has come down. Now, by various measures, we're between about 2.5 and 3.5. And the Fed would like to get particularly that purple PCE line down to the gray dashed line. So we're making progress. Again, today's news is good, heading in the right direction again, but not quite as fast as the Fed would have anticipated. So what's our expectation for rates? I think given the very strong job market news in December, given the fact that even though inflation's a little better than expected, we're still well above 2, we may be close to the end of this cutting cycle. So the blue line here, we're indicating probably one more cut in the Fed funds target in 2025 and not in the January meeting, maybe not till the middle of the year. For things that are a bit more relevant for housing, particularly the 30-year mortgage rate, our expectation is that longer term rates on average are going to stay relatively stable, close to where we are today over the next couple of years. So that means mortgage rates, averaging about 6.5% over the next couple of years, but really being swayed by the news from day to day. So a lot of volatility. So we think the right way to think about this is we're probably going to be in a range of sort of the low 6s to the low 7s over the next couple of years. Over the last week, when most of the concern was around the deficits and inflation, we'll be at the top end of that range. When folks get more concerned about a weakening job market, a slowing economy, all the global risks that I mentioned, both economic and geopolitical, will be at the lower end of that range. Obviously, another really important factor when you're thinking about the housing market is the demographic picture. And here just showing at the level of the population, again, your eyes naturally go to that millennial cohort, which is the largest group within our population right now. So you call it 50 million individuals between 30 and 40 in this country right now. They really are driving housing demand, both with respect to rentals and with respect to ownership. And you look at how that's likely to change. So the light blue here is sort of rear view mirror where we've seen that growth. So it's the millennials in the 30s and the boomers in their 60s. That's where the population has grown. If you look over the decade to come, again, that's shifting. Now, the millennial cohort is going to be going into their 40s, where you would have expected, they've established households, many would have bought homes, and most of that peak increase in both rental and owner demand will be behind us. That Gen Z cohort is noticeably smaller, and sort of that next generation, which I guess we haven't even named yet, smaller than that. So also all of this influenced by the immigration discussion with respect to demand for housing. But it will be interesting to note that we're probably looking at declining demand for rental properties as we go over the next decade relative to where we were this decade, just due to this population shift. And folks like the National Multi-Housing Council recognizing that in their estimates of new multifamily units needed per year. And you can see how that falls off as we get to the end of this decade and into the next. And this is already very much reflected in a slower pace of multifamily permits and starts, although we have a lot of units hitting the market this year. But looking at the single family market, so much of the focus the past couple of years has been on the lack of inventory, particularly existing inventory. And that's what's I'm showing in blue on this chart. That really has been the theme. If you look to the far right and squint a bit, though, I think finally we may be sort of changing that theme, at least somewhat, where as we got through the course of 2024, the lock-in effect, the notion that current owners just being much less willing to list their properties because they had such a low rate on their mortgage, I think more and more life is happening. People are having children, getting married, getting new jobs, other things that would cause them to list their property and move on. In addition, to a small extent, you are seeing some boomers who are saying, this is the time when they're ready to downsize. And a lot of that, as I'll show you, really reflecting the fact that they're sitting on a tremendous amount of home equity. So I do think really positive for those looking to buy this year is the fact that I think this inventory uptrend is likely to continue. So we'll see some additional properties hitting the market. Now, some of that has come from the fact that builders have picked up the pace of construction, seeing that here at the level of housing starts. But it really is something, if you look at just how low the pace of construction was for much of the past 15 years, and it's true on an absolute level in terms of the number of starts, but it's even more so if you look on a per capita basis. We really sort of dug a hole there by not keeping up with the pace of household formation. So there was a thought, and the press named it sort of the idea of a silver tsunami, that boomers were going to unload all of their large houses at once onto the market, and we'd find ourselves with the glut. Again, given this picture of very low levels of inventory, any additional supply would likely be welcome at this point. But we had Gary Engelhard, who's a professor at Syracuse, do a study for us to really dive into this. And he did that pre-pandemic and then did an update for us. And really the takeaway is it'll be some additional supply, but really don't look for it to be noticeable in many markets. Because a lot of these boomers really have made the decision to age in place. But the lock-in effect has certainly slowed the pace of transactions, particularly on the existing side. And that's why this change in the direction of that trend to finally begin to see some more inventory has us more positive this year that any additional homes on the market will support additional transactions. This has been a supply-constrained market with mortgage rates relatively stable and a job market that's hanging in there, even though it's softened a bit. We do expect more activity this year. So what do we think is going to happen with respect to home values? So here I'm showing the FHFA home price index. And again, the pandemic period was unusual in so many ways. It was true for home values as well. So if you look at that period in 20 and 21, we saw some rates of home price appreciation we've never seen in history before, approaching 20% at the national level. In 22, mortgage rates more than doubled. That cooled off very quickly, but stayed positive. Full year 24, a little less than 4% home price growth. And our expectation the next couple of years is that we'll be in a 1.5% to 2.5% home price appreciation range. So for current owners, news is good in that home price is still going up. For those looking to enter the market, I think the news is also good that they're not going up as fast. Wages growing about 3.9 to 4% annually right now. So finally, in a world where household incomes likely to be growing faster than home prices, and relief on the rental front as well, because we had such significant multifamily construction over the last couple of years. Again, those properties hitting the market now do expect that rent growth is likely to be relatively modest over the next couple of years. So after affordability really slipped away from us for a number of years, maybe it starts to get a little better this year. So our track on affordability is using data from our application survey, looking at median principal and interest payments across different types of loans. And again, here you see the impact of that more than doubling of rates in 22 at a time when home prices were increasing rapidly. That typical principal and interest payment went up almost $1,000 per month. It really unsustainable for a lot of buyers, and was the driver behind that cooling in demand. Since then, we've seen this measure kind of level out. So from a P&I basis, again, not that things have gotten less expensive, but potential buyers now are in a better position to be able to know what their budget looks like if rates stay stable and home prices are increasing at a much less rapid pace. So I mentioned this really dramatic pickup in multifamily construction. At one point, about 18 months ago, we had 1 million multifamily units under construction, which is the most we'd seen going back to about 1973. It's fallen off since then, and now we're seeing the rate of completions pick up. So all these properties being delivered to market. A lot of it in just a couple of handfuls of metros, particularly in the Sun Belt, and that's where we're seeing rent growth really decelerate the most at a most rapid rate. So some of this then gets to, okay, what's that trade-off or what's the comparison between folks looking to buy or rent? And again, showing here, back to that affordability chart, that median P&I payment has increased much more rapidly than typical new tenant rent. So again, this may be another reason why that average first-time homebuyer age continues to inch up, because for many households, perhaps staying a renter longer makes sense given this comparison, and again, in many markets around the country. So definitely want to touch on a topic that Chris and I were talking beforehand about, and certainly relates to, Chris mentioned the folks out in LA. This just puts an exclamation point on it. It's not just about principal and interest. We are also seeing very rapid increases in the T&I portion of the payment, the property taxes on the left, and particularly the homeowner's insurance and flood insurance components on the right. So that map on the right, and this is data courtesy of CoreLogic, seeing both very rapid increases in homeowners insurance premiums, and then just the level, very, very significant. And data from ICE really sort of emphasizing that. So this map on the left showing the proportion of the total payment due to property insurance. And, for much of the country, it's, single digits, low double digits, but You look in Florida, it's 15 to 19%. New Orleans is 25%. So a sizable component of the total. And then that chart on the right, just looking at what that average monthly insurance payment has done over the past 10 years or so. So up, 70% on a nationwide basis. Obviously, again, brings to mind this just horrific situation in Southern California right now, the loss of life, loss of property, and just all these poor folks who are just struggling to get through the situation. There is going to be a follow-on insurance impact as well as rebuilding concern when we get to the other side of this crisis. But there certainly have been a real focus on the insurance issue even before this. This is just going to magnify the concern and the difficulty of the challenge. All right, just a few more thoughts, and definitely want to be able to save time for questions and comments from all of you. So first, just looking at the pace of activity. The orange here is from our weekly application survey. So looking at total market purchase activity was looking up as we got to the end of last year. The blue is builder application survey. So just looking at applications to buy a newly constructed home, really much stronger. And really that was really just reflecting the fact that there just wasn't much existing inventory, much more new home inventory available. Refinance, not as much of a factor given the level of rates today, and that you have about 2/3 of homeowners that are well out of the money with respect to a refinance. But September of last year, rates dropped to the low sixes, and we saw this real burst of refinance activity. And that's our expectation in 25 is refinance isn't going to be a big part of the picture, but there may be moments when we're at the lower end of that trading range for rates where it really does pick up. This is our expectation for origination volume the next couple of years. So after a very tough year, if you were a lender in 23, 24 was a bit better. And we expect 25 to be a little more than 2 trillion. So not a fantastic year, historically speaking, but better than what we've seen. And the blue indicating that this is going to be a world where most of the mortgage loans that are originated are for buying homes. Right? Refinance will be sort of on and off, but won't be a big contributor to the totals. When you think about the performance on mortgage loans, it tends to track very, very closely with the unemployment rate. So spring of 23, when we were at that 60-year low for the unemployment rate, we hit an all-time low for our delinquency rate in our national delinquency survey. Since then, it's trended up, but again, you can see historically that delinquency rate is really quite low when you're looking at the full market. Bit of an exception if you look just at FHA loans. We're now above the level of delinquencies that we saw pre-pandemic. So, home buyers that got in when affordability was really very challenged, debt to income ratio is really quite high, and perhaps being impacted by some of the softening in the job market that I mentioned. Always sort of expect that's going to show up in the FHA market first with a borrower who's a little more stressed even going into the transaction. But this is a noticeable increase in that FHA delinquency rate, and definitely something to watch. So Chris and Elizabeth, let me stop there and stop sharing, and happy to take any questions or comments at this point. Hope that was useful information.
Oh, most certainly, Mike. Thank you so much, on behalf of all of us. Really so appreciate your ability and MBA's ability to bridge together so many different metrics, right, to help tell that story. And then, of course, the way that you're able to weave that in developing your forecasts. It's just such valuable information. So thank you. And we did have a couple of questions. Certainly there was a note with the presentation we made available. Yes, that absolutely.
That's always the easiest question to answer, yeah.
Posted, but I'm glad folks asked, right? That'll be uploaded. Mike will post your PDF version of that at ncst.org. So I'll go ahead and take some prerogative here to get things rolling. You mentioned MBA. It's forecasting in all likelihood the next couple of years 6.5% mortgage interest. And while that's probably not the news that many would like to hear, particularly those that might have become accustomed to 2, 3, 4% rates. On the other hand, at least home buyers can manage their expectations. I'm wondering, though, what repositioning might need to happen in the industry or the thought process for prospective homebuyers. Are there changes that might be informed, like how much home should be getting built, or perhaps even which markets they should be built in?
Yeah, no, great question. And, I always have a picture of my mind of sort of this time of year, a household that was thinking about buying a home, sort of sits down, thinks through their budget, sees where mortgage rates are, sees where home values are in their neighborhood, maybe talks to a lender, talks to a realtor, talks to some other advisor and says, okay, this is our budget, this is what we're going for. The challenge is in a year like 2022, they did that, and then mortgage rates doubled over the time they were shopping, and they were having trouble finding any properties. If they found a property, there were 6 other bidders there ahead of them, right? I think we're in a world that's just a little less crazy in 2025. So they can set that budget. And again, if our forecast is close to right, when they're going out and looking at the market, and there will be properties for them to look at, and maybe a couple of other bidders, not 10 other bidders, it can be a more thoughtful, considered process and making sure they're getting a property they can hold on to and sustain over the long run. I think builders are sort of recognizing that this millennial group, that's where the demand is coming from. So steering some of new construction towards home sizes, sort of price points, more apt to attract more of those first-time buyers. We're seeing FHA share in the new construction market up to 30%. We were sort of mid-teens not too long ago. So again, reflecting that more and more first-time buyers buying new construction and new homes available for that. One thing that we're focusing on at MBA is some of the challenges in the condo market right now, which are often a choice for first-time buyers being more affordable, but a lot of challenges coming out of some of the new sort of lending criteria at the project level, which are making that a little more difficult. So that's something to work for on the advocacy side. But those are just some thoughts. Hope that's helpful.
Mike, no, it absolutely is. I really appreciate the context there. All right. There is a question here. What can we expect with multifamily apartment loans that are at risk of default in 2025, and then looking, with your crystal ball into the future beyond that?
Yeah, so putting on my commercial real estate hat for a second, right? If you think about the different property types, the office market is very much struggling, right? Because of return to office or not, and the various challenges that downtowns across the country are facing. So that's the property type that people are most worried about. Multifamily, I mentioned, we're getting a lot of properties delivered to market, and there are places where there's a bit of a glut. So when you look at delinquency rates for Fannie Freddie, FHA multifamily, in CMBS, they're increasing, but still relatively low. And this is just more of an issue of it's going to take some time for those new units to get absorbed. Again, we have seen rents come down, or at least the rate of rent growth come down. We're seeing more concessions being offered, but not seeing a huge amount of defaults, honestly, in the multifamily sector. And that's different from office. So, where I sit in DC, there are foreclosures of office buildings all around our office in DC, but that's not what you're seeing in multifamily generally. There are certainly segments of stress in the DC market. There are some, particularly in affordable multifamily, but it's not the level of distress that we're seeing in some other sectors.
Understood. And also speaking on, it's a hot topic particularly today. There's a question here: demand for multi-housing was shown to decrease. However, there's a big push in those legacy cities. You were talking about DC. But if for no other reason than affordability, to use multifamily housing to help alleviate the housing crisis. Wondering here, Mike, if you can discuss that disconnect. If we build a bunch of multifamily units, are we risking a vacancy crisis?
It all gets to the substitutability, right? To be an economist on this, right? To what extent or is somebody that is really looking for a suburban home with a yard, what would keep them downtown in an apartment? And you saw that that population picture I shared, right? That that question is different for somebody who's 25 versus 35 versus 45, and sort of given the trend in that millennial group. Right now, there's probably a bit more substitutability than there's going to be 10 years from now. So it's a matter of sort of trying to think ahead, whether you're a market participant or working in a city business development office. Like be aware of some of these demographic trends that we probably are now moving past the point of sort of peak rental demand, and we're moving more to a structure of the U.S. age distribution that's going to be more leaning into single family ownership than was true 10 years ago.
That is really helpful context. And and your point about being aware and being aware in the markets, right, where folks are working, I think is just crucial. Again, it's clearly a hot topic. There's a question here, and I wonder if you could speak to, with respect to multifamily housing, those conversions, right, of vacant office space, underutilized space that might open up some residential development, but as multifamily.
Yeah, definitely hearing a lot about that. Again, when we talk to our commercial members, there's is sort of the site and the floor plan of the building, does it even make sense? And that's sort of the first set of questions. Then is, okay, if you go to redevelop it, is it a knock it down, start afresh, or is it really something that can be quickly converted into a residential rather than office setting? And that's going to be sort of building by building. And this is another one where solutions in DC might be very, very different from solutions in Omaha or other parts of the country. We hear about, I think, a higher than expected number of cases in places like Houston, for example, where those conversions are making a lot of sense. And other parts of the country where a little bit of a nudge, a support, property tax easement, or some other benefit where the city's supporting that convergence making sense. I think if you're in one of those cities that I described that's getting this absolute flood of new apartments being delivered, this is probably a less important issue for you, right? That you're a bit more concerned about having too much rather than too little. So other potential uses for those office properties, converting them to medical office, or again, sort of don't want to overly rely on DC anecdotes, but there are universities that are buying up vacant office properties in DC, right? So there are other ways to redeploy those office properties, and the whole sort of mantra in real estate is always highest and best use, right? So there is going to be a good use for that land. Not too worried about that. Just got to sort of let the system work.
No, it makes a ton of sense. So moving into a different space, there's a great question here from Karina Johnson. She's asking if there's any ideas around the demand for renovation loans, and specifically loans for ADUs. ADU is a solution for helping seniors to remain in place on that, but of course needing to have the financing to actually get that accomplished.
Yeah, no, I think I mentioned to you before we started that this time of year I'm doing a lot of similar conversations to different groups, and was just at one on Monday, and got to talk to a whole group of people who are up in New England, are focused on renovation lending, right? So older housing stock, a place where it's difficult to do a lot of new construction, but there's a lot to be gained from using a FHA 203K or a Fannie Mae home style to get that stock sort of ready for today's market again. So I think it's one of these sort of interesting circumstances where there really are differences in different parts of the country depending upon things like the age of the housing stock, the nature of that potential home buying population. I think for, many prospective first-time home buyers, doing a huge renovation as much as everybody likes to watch HGTV, like that's a big deal and a lot of risk, right? So it may not be appealing to every buyer, but to have tools available for those that are willing to take on that challenge, I think it makes a lot of sense. On ADUs, boy, I think there's a lot of experimentation out there right now about both with respect to, how do you think about using that potential cash flow as part of the loan qualification? And exactly to your point, I talked about boomers sort of voting with their feet, saying they want to stay in their properties longer. If this is one way to help them do that, boy, that makes all the sense in the world, because then you're providing a more affordable rental for that tenant and you're providing that cash flow to that senior. That makes a lot of sense.
Yeah, opening up opportunities for housing literally in our own backyards, right? Well, excellent. Well, at this point, Michael Fratantoni, I really want to thank you again. It's a pleasure having you join us the top of the year. It's a great way to kick this off, and so want to thank you for joining us today.
Thank you.
With that, joining us to provide updates and insights in the federal policy regulatory lens is NCST's Senior Policy Director, Elizabeth Coates. Elizabeth, good afternoon.
Good afternoon, Chris and all, and thank you again, Mike, for the very informative presentation. This has already helped the gears in my brain turn a bit on how it is that it's important for us to message housing affordability needs and homeownership gaps that continue to persist, particularly for a new audience here in Washington, D.C., with the Republican trifecta, with Donald Trump coming too soon to the White House and Republican control of both the House and the Senate. That does not mean that our advocacy lets up. In fact, this is all the more reason why it's important for NCST to continue to elevate the importance of supply needs, particularly for owner occupants, as well as with new construction and rehabilitation and acquisition needs in the single family space. So if that is something that is of interest to you, and if you have more questions on our approach, if you've got certain concerns that you have that you see within your community or federal programs that are depending on for the work that you do, and you want a partner and you want an advocacy effort or advocacy pusher, please know that you have that in us here at NCST. So as I mentioned, affordable homeownership will remain the focus. Particularly from the supply side. So not only what is it that we can do to support owner-occupied housing from the new construction side, but also how can we continue to take advantage of the housing aftermarket? How can we look at distressed assets? How can we look at vacant properties? How can we look at pools of loans and to be able to ensure that homeownership becomes the result from all of these, uninhabitable methods as of now, but being able to add to affordable supply in that creative method that we continue to facilitate and depend on many of you all, buyers and community buyers and homeownership alliance members to participate. I think that as everybody's sort of taking stock of post-election and how is it that we are looking to a second Trump administration, what does that mean for housing? Who is going to lead all the various departments? Who's going to have the pen as far as what a tax package might look like, on what funding might be available for housing programs? NCST's approach is one to continue to bang the drum on the need for affordable supply. We've heard across the campaign trail, across the aisle of different parties, all recognizing that affordable supply, there is a dire need of that in our country, and to be able to have the federal government participate in very thoughtful methods is a way that we'll be able to see those costs come down. We'll be able to see more homeowners. So through that, we want to ensure that Congress and the administration understand that that is a surefire fix. And the way that we can ensure that everything that we're elevating to federal lawmakers and regulators is going to work on the ground is through our homeownership alliance. If you've been on these calls before, you've heard either myself or my colleagues speak about NCST's trade association made up of nonprofits from across the country that all have a focus on owner-occupied supply and are looking to enhance their federal advocacy presence. So that is managed by myself, and we already have had one new member join, which we're very excited. And if any of these policy homeownership conversations are of interest to you, I encourage you to check on our website and learn a little bit more about the Homeownership Alliance. You've got lots of opportunities as a member to learn from your fellow peer organizations. How is it that you all are approaching the insurance conversation in your part of the country? How is it that you're able to work your way around some Davis-Bacon regulations that are getting in the way of new construction efforts that you might have? How are the new 203K rules impacting your work? Are they beneficial? Are they not? What should we message to the new HUD as the new secretary undergoes his nomination? And how can we make sure that the good ideas are continued and those that are maybe misguided, what practitioner-informed information can we lend to federal lawmakers and regulators to steer them in the right direction? That is just about everything that we talk about in the Homeownership Alliance. And myself and the policy team at NCST, we really lean on those insights. That's what helps to steer us in the right direction. So if I've tantalized you at all with opportunity of membership, please click on the link I've just put in the chat. There's an interest form there, and I watch that religiously, and you will be able to hear from me if this is something that you want to learn a little bit more about. Speaking more of Congress and what is ahead, folks might have heard a little bit or maybe a lot about 2025 being the year of tax. This is at the end of this calendar year is when the Trump era Tax Cuts and Jobs Act legislation will sunset, or those tax credits passed 5 years ago will expire. So that means, particularly now that we've got the same congressional makeup, at least in leadership, that we did when the TCJA was passed, that there is an effort to continue those tax credits, as well as add some other pieces of tax legislation, changes to the tax code, to be able to follow the, or at least to be able to align with what the values are of the current congressional leadership and the incoming administration. As I mentioned before, housing is more a part of the conversation than certainly has been since I've been doing advocacy and since I've been doing housing policy work. Perhaps those of you that have been in the field much longer than I have might agree. So that means you have to pounce on this opportunity. And thankfully, NCST co-chairs a coalition that is looking to lead the Neighborhood Homes Investment Act to passage. You've heard me speak before, you've heard me talk about this. This is NCST and the Homeownership Alliance's top legislative priority. The Neighborhood Homes Investment Act would create a tax credit, a federal tax credit, first of its kind, that is solely focused on the development, rehabilitation, and acquisition of single-family housing for homeownership. We, as many of you know, probably even better than I do, based on the work you do in your communities, that the best way to be able to revitalize neighborhoods is through increasing the access and affordability to homeownership. And the Neighborhood Homes Investment Act will provide these key investments, spur public-private partnerships, empower mission-driven organizations to be able to use an additional subsidy to continue the great homeownership development work that you do, particularly honing in on the value gap that so many of your communities are seeing now. The cost to construct or to fix up a home far exceeds the cost at which it can be sold to an eligible lower moderate income home buyer. And that in turn is stalling the home ownership process for so many communities, particularly in those that are experiencing distress. So this tax credit is one that we do believe would be able to bring some relief and some much needed supply back online. As you'll notice from the link I just put in the chat, there are lots of national partners that are involved with this. We really are looking to see how it is that Neighborhood Homes Investment Act can be included in a tax package. And it may be reassuring for you to know, or to be reminded, that the Neighborhood Homes Investment Act is a bipartisan piece of legislation. We've got both House and Senate, Democrats and Republicans, signed on to this bill. So our focus as an advocacy coalition is going to be ensuring that when the Republicans take on the tax package, they're going through a convoluted process that really has them only needing their own side of the aisle to vote, since they got majorities in both chambers. It's more that anybody wants to know. I won't bore you with the details. Unless you want to know, then email me and we could talk about it. But essentially, we're going to have to do a lot of very targeted advocacy toward our Republican champions and potential allies to educate them on the importance of this tax credit, on the need for additional housing supply. And fortunately, many in the Republican Party do understand the importance of homeownership. So we believe that while there is lots of procedural hurdles to surmount, that we are not in a place where we're having to convince congressional leadership that this is something that's important to focus on. So rest assured that this is going to be the approach for NCST and our coalition. If you are interested in learning more about the Neighborhood Homes Investment Act, you've got that link there to our coalition website, and you will also see interactive maps that are right on the coalition's website, where you can zoom down to the census tract to be able to see how it is the neighborhood homes tax credit could potentially serve your community. And rest assured that over the past Congress, we've learned a little bit from some of our advocacy partners, as well as some of our Homeownership Alliance members and other community community alliances, that there might be some changes required in this bill to ensure that it's going to be something that's workable. So we, as the coalition, have been very responsive to that. Costs have gone up everywhere, and any good policy practitioner is going to take a look at what are some measures, what are some kind of dial changes, what are some updates that are required in light of these surmounting costs, to make sure that the neighborhood homes tax credit can actually work for you all on the ground. So again, this is a part of our commitment to the practitioner, that all of our policy reform recommendations are going to be rooted in what we know works for you. So all of that to say, we've been in constant conversations with the Hill to make sure that the new version of the Neighborhood Homes Investment Act is going to be the one that can be implemented on the ground. That about kind of serves it for today, at least where we're at. Lots more coming in the pipeline as nominees come through, as the inauguration takes place, as we're able to see how it is that the Congress wants to look at tax and many, many other housing issues. If you are interested in discussing any of these items, I've got my email in the chat as well. Please reach out. This is my favorite thing to do, is talk politics and how it is that we can use that mechanism to improve our lives, particularly in the realm of housing affordability. And if you're interested in joining from the Homeownership Alliance, we are actively recruiting. We're about to start our 2025 dues season. It'd be great to have you on board. Thanks so much.
Elizabeth, wow, thank you. Clearly, if nothing else, 2025 promises to be an exciting year. So appreciate you breaking it down, right, from your vantage point. Thank you. And to our attendees today, thank you. Next month, we'll be back. That's February the 19th. Please mark your calendars for the third Wednesday of the month. We'll look forward to seeing you then. So with that, on behalf of NCST, have a great rest of your week. Thanks so much.